Good morning, everyone.
Good morning.
Okay,
thank you.
Thank you, Gustavo. It's great to be here this morning in Sao Paulo. Great to see the interest in Insurtech and innovation in the insurance industry. I was at the 3 Insurtech Connect conferences that have taken place in Las Vegas so far. So I was at the first one. I think there was about 1,500 attendees at that. And then over the last couple of years, the conference has grown to 3,000, and then last year to 6,000, and we don't know how big it will be this year. So, Gustavo, I think that's what you should be aiming for. I think you have about 1,500 here, but in a couple of years, 6,000, right? So we'll get there. So I think there's a tremendous amount of interest in this topic. It's great to see everybody here today. We at Marsh, we have a lot of interest in Insurtech and in innovation. There's a lot of investment going into the industry. I know there's a lot of investors here in the audience today, and that is starting to change the industry. There's investment from venture capital, there's investment from industry players like Marsh, but I think we're at the very early stage of this. It's really the very beginning of what I think is going to be a very big wave coming through insurance and technology changing the way the industry works. I think much of the investment and change has been to date in the more personal lines part of the industry, a lot focused on distribution models and bringing digital distribution to the industry. But there's going to be fundamental changes, I think, across the industry through time, moving up into the large commercial space, which is really where Marsh's business is centered today. So we think it's very important for the industry to start embracing this change, and we think the winners in the industry will be those who do embrace the innovation, work together with the Insurtech community to fundamentally change the industry. The topic that I'll talk about today in terms of real-time risk management is really, I'll paint a picture of the future that we see evolving, and I think this is true for all lines, from personal lines through small commercial to large commercial, in the way that this change is taking place. Now, it's taken place most significantly in personal lines, and I'll give some examples there, but it's also taking place in the commercial sector, and we're starting to see the early changes in this direction of real-time risk management. So a major theme of this talk is going to be change. So I thought I would bring this quote from the Greek philosopher Heraclitus that he said this 2,500 years ago in 500 BC, that everything changes and nothing stands still. And I think that's very much the core of what I see taking place now in insurance. There's a lot of different changes across the whole value chain, distribution, underwriting, claims, and really things that connect those, and changes coming from technology, changes coming from new forms of capital, and I'll talk about all of those, but I think I think we haven't seen yet how all these changes are going to come together, and that's part of what I'll try to paint a picture of today. So before I jump into the forces changing the industry, I think one of the pictures I wanted to paint for you is kind of what is how the industry in moving from where it is today to what I'll call the real-time risk management model. Think about what the industry is today in terms of how it looks and evaluates risk, right? So traditionally, insurance, with all of the actuarial science behind it, is looking backwards in the sense to evaluate how risky an insurance proposition is, right? You start looking at what claims have been had historically, what losses. There's lots of actuarial science in evaluating historical losses. And basically, we're trying to predict the future from historical patterns, historical losses of what's already taken place. We're also looking at policies that are usually written once a year. They're usually, this evaluation takes place once a year, renewed at that time each year with perhaps a new evaluation at that point. So the change I want to talk about is shifting the lens from the past to predict the future to having more dynamic measurements that actually tell you something about the risk now. And as it's moving, how can you change the pricing or the coverages in insurance policies to match what's taking place as the risk changes? Because risk doesn't only change once a year. It changes throughout the year, and yet in general, the insurance industry doesn't reflect that in the way that it's underwriting risk, in the way that it's pricing risk, and really in the whole industry structure revolves around looking at the past rather than looking at current measures of risk and using those to change the way the insurance policies are developed. So that's kind of the underlying theme of this, and I see this change taking place in a variety of sectors, but we're at the very early stages. So in terms of what are the things that are going to propel this change to a more dynamic, forward-looking risk management? So one of those forces is new streams of data that we didn't have before, and now we have, and we should be using because these data streams have risk content in them. So think about telematics in cars. That's probably the one that's been around the longest of the ones that I'll describe, where the telematics in a car can tell you not only what's happening, whether the car is being used, but also is the driving behavior risky or not. So if you used to price a personal auto insurance policy by looking at what kind of accidents people had in the past, what sort of losses they've had, you can now look at, well, what's happening right now. Are they driving well or not? Is that behavior consistent? Does it predict that their losses are going to go up or down? So that's a signal that's coming that we didn't really have before, but now you can say, I'm not just going to predict the losses from what happened previously in someone's driving record. I can look at how they're driving right now and make an even better prediction and a more dynamic one. So someone who used to be a bad driver but now is good, or used to be a good driver and now is bad, might deserve different treatment in the insurance world. There's also wearable technology. It can give you a dynamic indicator of someone's health. It can give you a dynamic indicator if you're putting put everyone in a construction project, put some wearable technology on them. You can get a sense of whether they're more likely to be accidents on a work site. So you can use this to manage the risk itself and kind of reduce the risk, but also start to look at, can you build connected insurance policies that would actually flex in their coverage or their price based on what signals are coming from the wearables. And similarly, you can get satellite pictures or drone technology pictures, very impressive drone usage that Gustavo showed. But drones can also be used to take pictures of flood sites or other types of natural catastrophe damage and use that in the process of evaluating claims. And then finally, of course, there's mobile phones and all the information there. Obviously, you can buy insurance now on the phone, but you can also send signals, take pictures of, after a car accident. You can and send that in for part of the claims process. You can also use the phone actually as a telematics device. So lots of different things that can come. But the main point I want to make with this slide is just that these are new data. So in the past, if you were an actuary, you didn't have the benefit of this data to start evaluating the risk. But now it's coming in, and if you can process it, it's actually giving you a live signal, a more real-time signal of the risk. Now, part of the challenge with all that new data is there's a lot of it. I mean, if you ever look at what the various data that can come even just from a telematics box in a car, there's a lot of data. It's hard to find simple analytics to grapple with it. But this is where the advances in AI and machine learning are an important parallel development to the new data. Because you can push that data through a machine learning model, and actually use that new analytical technology to determine whether or not the risk is rising or not. So I've seen different applications of this for underwriting, for claims management, and really up until just maybe 2 or 3 years ago, the AI wouldn't have been powerful enough to process the vast amount of data that would come through these IoT devices and so forth. Now it is. Key tests of the development of AI has always been, can the technology process images better than the human beings can process images in terms of distinguishing features in, comparing one person to another, or comparing, say, a lion to a leopard. Can you tell which one is which? So it used to be that the human brain was much better at doing this than AI, at sort of image processing. Because images, it's a lot of data when you're trying to process it. Now, though, AI is better. So AI can process images better than we can. So if you think about images that might get sent in, again, from, say, a picture after a car accident, it can now be processed extremely quickly, and you can make an estimate of what the value of that loss is using the technology processing the image, which you wouldn't have been able to do with quite that degree of accuracy even a couple of years ago. So this is another, I think, key development, and why Insurtech is changing things now that maybe couldn't have done this 10 years ago in quite the same way. New data, new AI. And then the other key development, different but related, that I think you should bear in mind, you think about how the industry is changing, is new forms of capital. So the so-called alternative capital coming into the market, which is really coming from financial investors, pension funds, hedge funds, sovereign wealth investors, and other financial market participants are getting very interested in insurance risk. Why? Well, most of their investments are, say, stocks and bonds, so financial market instruments that tend to be correlated with each other, whereas insurance risk is unrelated. Hurricanes and earthquakes happen with a different pattern than stock market rises and falls. So the financial and market investors are getting interested. If the industry can create instruments for them to take the risk, they're willing to put investment against that. So you see here with the chart, this is just looking at pension funds where there was more surveying done, but there's $35 trillion of investment capital in pension funds on a global basis. Those pension funds have earmarked $1 trillion of that 35, so only about 3% of their total portfolio, but that 3% is $1 trillion to go into insurance-related investments. And to date, only about 80 billion of that has actually been invested, mostly in things like cat bonds and other kind of reinsurance-related instruments, rather than directly into the insurance risks that we are underwriting day to day. But nonetheless, a lot of interest. So you think about, you could easily deploy 10 times that today just based on the interest that pension funds have today, and that could grow from $1 trillion to more. But that $1 trillion will significantly change the industry if it starts to get deployed. Well, the insurance industry today on a global basis is only 2 to 3 trillion of capital. So this is a big injection of interest in the form of capital from alternative markets. Now, how does this relate to what I was just describing in terms of data and analytics? Well, one of the things that alternative capital, they're interested in investing in things, risks that can be modeled statistically. Seem to have lost, there we go. That can be modeled statistically. So the money that's been invested to date has been primarily in natural catastrophe risk, where they're looking at hurricane models and earthquake models and things of that nature, and they're using that to gauge the risk. They don't really want to get into transaction by transaction underwriting in a traditional insurance sense. They don't want to manage the claims. All of that will be done by players in the market today, but they are interested in putting capital in, and if things can be underwritten statistically so they can look at a model and it's a pool of risk that they can compare in performance terms to stock and bond investments, then they're very interested. So I think as data and analytics in the industry progresses and more of the risk can be modeled, and maybe, again, using these forward-looking indicators, you can get a more dynamic model, which is obviously what these investors are used to, because they're getting their other risks are being repriced every day and even every moment on a real-time basis. Then they'll be more and more interested in insurance risk. So I think these trends come together. You have new data streams that give us a forward-looking picture of risk, new analytics to process them into a kind of risk score or more simple way of looking at the risk, and then new capital that's interested because these tools exist. So I think that's gonna power a lot of the change in the industry. Okay, so now moving to the application, what will this lead to? So I think now looking at some commercial examples, because I'm sure that you'll see a lot of consumer examples throughout the conference, and I'll talk about a few, but our business is mainly commercial risk management, and we think these new real-time data and analytics can help our clients, large companies, actively monitor and mitigate their risk collectively. So you see an example here of like a construction site where you can put, through wearable technologies and other sensors that are put on equipment, you can monitor the risk on a construction site, or for that matter, in a manufacturing plant or any kind of business, using the data coming from these sensors and produce more of a dashboard, as you can see the construction manager you're looking at, that may tell you where is the risk that's starting to take place, can you intervene to reduce the risk, and that type of more active risk management can reduce the potential for accidents, for claims, for losses in this example. But really you can think of almost any other example as well. Like, for example, take telematics. If you're running a commercial fleet, you want to monitor the behavior of the drivers you have and whether they're engaging in risky behavior that needs to be changed. Again, you can do that today in a way that you could not do it previously because of these things. And so that active risk monitoring, for many of our clients, they're actually taking the risk. They're self-insured, so it has a direct impact on their financial performance. Or if they're transferring it into the insurance markets, which is where we come in terms of our risk brokerage, they can potentially make the case to the insurance markets that with all of these risk management tools in place, they're a better risk than the other company that doesn't have them and should get a better price on their insurance. So whether they're keeping the risk on their own balance sheet or they're moving it into insurance markets, they should be able to reduce the risk and get better risk pricing. A different example is that this whole change is leading to new insurance products. So sort of the example here, you see this sort of ski slope and people on their phones. I mean, there are now companies that will give you a price for, say, insuring your skis for a day. So you can imagine that this picture is someone, they have the skis in their list of contents, they're connected to their insurer. You say, okay, now I'll slide the toggle and now I'm insured. And only keep it on for a couple days and then turn it off, now I'm not insured. Right, so that kind of thing happens. There's these time-boxed insurance policies that last only for a day or 2 days rather than the traditional year. You can insure one item rather than, say, all of your property with this type of thing, so you can get a very atomic picture of the risk. So that's one new type of product that's being developed, mostly in the consumer space right now. but where you can imagine this developing going forward. A different type of product, coming back to my comments around connected policies, is really when they're connected to these real-time data streams. So where you have, for example, with the telematics case, the idea that if your driving behavior is changing, you'll get that's connected in your insurance policy to the way it's being priced, and you'll get a credit for good driving behavior. That's a new kind of policy. You have new policies being developed, say in the homeowner space, where people now have put their houses on Airbnb, for example. And so when you're now really running a commercial property when you're there, so you need a different kind of insurance versus being just in a homeowner's policy. And the policies being developed that shift between the personal and commercial. So lots of new insurance products, many of them, and what I mean by dynamic is that there's a linkage, dynamic in the sense of you can turn them on and off, or dynamic in the sense that they're linked to one of the data streams and it's changing the pricing or the coverage based on the way those feeds are coming in. And obviously all of that requires much more digital connectivity in the industry. And then another change is on the claim side. So this is, okay, now you have events taking place. How can you process those? So I've talked about this a bit already in that with better image processing, you can start to use technology to process claims in a way that you couldn't before. So everything from taking pictures from drones or satellites of, say, a flood zone after a major natural catastrophe, and making immediate assessments of what the damages to different properties would be. So imagine now, rather than sending out loss adjusters to all of these homes, you're basically, if you're the insurer who has the risk across that flood zone for a number of homes, you basically take the pictures that are coming in from the drones, you take a feed of real-time weather data, which can give you, at a very micro and granular level, what the weather was at particular sites, combine those, and using AI, make an estimate of what the damage of to the home is, and then just settle the claim there and pay the homeowner, give them their claim value right away. No forms to fill out, no adjusters to send. So it's a bit in the future, but maybe not as far as you might think, because the image processing really is getting better. There's a lot of tests being done to see if it's good enough to substitute for loss adjusters in certain areas. It is happening in things like auto accident claims already, but even on large-scale things like homeowners and commercial property damage from floods, you're starting to get the sense that this could be reality relatively soon. So those are some of the things that are happening, but now I just want to give you kind of what I see as the kind of fuller picture of how these things come together. And this is what I'm calling the real-time risk management. Right, so that you have, on the left, you've got the new data sources. So that's wearables, it's telematics, it's property sensors, and then getting fed through into some type of machine learning process that outputs a risk score, which you can use either to mitigate the risk if you're taking it yourself. And so this could be, from a company standpoint, could be taken in their captive, where they have their retained risk, or into the insurance markets, where now either with dynamic and connected insurance policies, and maybe supported by alternative capital, you have a different risk-taking community evolving. So this is the picture. Think about how these things come together, and it's a different industry now, right? In terms of the way risk is being underwritten, it's actually the risk is being evaluated more dynamically through these, the real-time data. It's also claims are being processed much more rapidly and through a chain of new data coming through. And there's new policies, there's maybe new risk takers in the form of alternative capital. Now, I think there's a lot to be done for players in today's industry, even if this model emerges. So I don't think in any way it's going to completely substitute for what we have today in terms of who's going to be the key entities. I think a lot of the large insurance companies, certainly we hope the large insurance brokers have a role in this model. But I think it's adapting this and starting to see that if this is the direction of travel for us, then we need to start getting in front of that and changing ourselves. So now just a few examples. So probably the place where this has been most developed, this whole idea of the connected chain from real-time data to new policies and so forth, is in personal auto insurance, and now emerging more also in the commercial auto insurance space. But let's stick with the personal. So this is the chain I described. You have telematics coming from cars, it's change in driver behavior, it's usage. You have started with some usage-based policies instead of annual rates, so you pay more if you use the cars more. That requires a signal from the car. But also the driving behavior, looking at the quality of the driver, so that's changing the way that the insurance is priced, or you get some type of credit. So there on the right are some of the players who are already doing this. So you see some of the, like Metromile is an MGA that started as an MGA, now it's an insurance company that was really founded to do this type of work with telematics-based insurance. And then some of the big players in the US, Progressive, Allstate, you see some of the big European players. And then here in the region, a number of telematics players who are starting to create the data streams. And then in the example of Octo in Mexico, connecting it to a policy with Qualitas, so that there is now a connected chain of, through the analytics and telematics to the actual insurance product. So this is one that's already taking off. It doesn't have, most policies aren't done this way, but more and more are getting done this way. And I think, again, it'll expand from the personal auto lines into commercial fleets, of personal cars. You see many of the ride-sharing, players like Uber and Lyft are very big on this. They're using this very actively to manage the risks that they face. So now another example out of the transportation arena, where I think this really has a lot of potential, is in the marine area. So now think about these signals coming from the actual ships, as where are they? What waters are they sailing through? What ports are they coming into? Is the ship functioning well? You have all these IoT devices that are on ships for different reasons, but they haven't historically been used to track the risk of the boat or its cargo as it's moving through the waters. So we're working with a company today, Cqcs. It's a marine analytics company based in London that's doing exactly that. So they've got information on all of the ships around the world. They're getting IoT data from those ships. They're getting data when they're in ports. They're getting all these signals. Now, to date, what they've been using it for is, again, to help insurance companies underwrite their marine risk better. So those are users of the analytics. But you could also imagine this evolving into different form, where actually you maybe change the way insurance policies are done in the marine world. Maybe there's a risk taker that doesn't want to take the risk when ships are going into war zones. But maybe there's another risk taker who actually is happy to take that risk, higher return. So you can imagine a policy that as the ship is moving, the IoT is sending the signal as to where it is, and then one company's on risk for a while, then it switches, moves to another company that's on risk when it shifts into a different zone. So you can imagine this process as one of the things that could emerge from the new marine analytics technology and all of the new data streams coming from there. And then, again, extending it to the cargo side. Again, there's IoT data, or IoT devices on the cargo. So again, you can kind of track it, what ship is it on, where is it in port, and different parts of that chain might lead to different risk takers that are interested in parts of that, and also help monitor and manage the risk of the cargo as it's moving through. So I think lots of potential in the IoT data, and also in addition to IoT data, of course, there's live weather data that you can get, and that may also change the risk pattern for ships at different points in time. And of course, it does change the risk. They're sailing through troubled waters, and so it becomes, is there a certain trigger where it actually moves it into a higher risk policy because it's in a higher risk environment? So different thoughts. Again, this hasn't all been processed into profound chains yet in the marine market, but it could be. And the data is already there, and there are companies working on it, both in the analytics sector, as I said, but also shipping companies, insurance companies that are looking at this data and how it can be used differently. So now what about property insurance? Big class of insurance. So again, think about the left side, the kind of pre-loss here. So this is kind of the underwriting side, where you might have now sensors at a building. You have smart buildings. They have sensors all over telling you about the temperature, the potential for to break. They're looking at where you may need to replace equipment so that the building continues to operate well, so forth. So a lot of sensors that are being put in place generally for safety or productivity or managing costs, because you don't have to heat rooms that nobody's in, those types of applications, but it has a lot of risk content to it. So you take that, and you could also take information from drones. I mean, a big thing looking at property insurance, you want to look at what's happening on the roof. So you can take pictures of the roof, from the drone and send it in, again, have a more dynamic picture of what's going on with that building from the sensors and from the pictures, rather than, again, sending out a lot of people to do this, or only getting it infrequently done. You can have a very live and dynamic view. That will help, I think, and can connect to a new chain around a more connected policy for property risk. And then post-loss, as I was describing earlier, for claims management, you can get pictures from of what's happening in the building, from the sensors, from satellite imagery, from weather data that can tell you what happened exactly at that point, and maybe start to process that into some type of estimate of damage that doesn't require as much time or as much investment in people to do. So you can do it through the technology lens. So you may have seen there's been some developments in this space in the personal homeowners, where you saw there's a partnership between Amazon and Travelers for, if you put in enough of the Amazon home, sort of smart home technology, you can get some credit on your Travelers homeowners policy. That's sort of the basic version of the left-hand side here, where connected policies can actually, because you can monitor what's happening in the home from a safety and security standpoint, as well as from a potential property damage standpoint, you can give homeowners a credit. But you can imagine the commercial variation of that. It's a lot, more challenging to process all the information about a large building. But nonetheless, with the data and analytics available today, there's better ways to do it than the way we're doing it today. Finally, casualty insurance, and you have the example here, and I've discussed it before, around the wearables and how you can do that into a connected policy as well, and different ways of, if you extend this, I'm talking primarily about the commercial insurance industry today, property casualty, but obviously wearable devices and can also be used to monitor health, and health insurance is another big potential area of application for this. So just one additional thought around if you have this new system being put in place, lots of AI, lots of IoT that are starting to be deployed. The other challenge in terms of thinking about deploying it, whether as an individual or as a company, is that if you put all the technologies there on the left do create benefit for you. You have new risk signals, maybe you can manage your risk better, but it actually creates a new risk for you, which is you now have expanded your cyber risk. So it's a little bit of a warning flag in that it's not to say we shouldn't do the things on the left. I think we need to, but be conscious of you've now widened your attack surface because every one of these IoT devices is now another entry door for a hacker. And of course, cyber at a company level is now the #1 global concern. This was sort of at Marsh, we partner every year with the World Economic Forum to look at risk globally and what are the most critical risks facing the world. In our business leader survey this year, cyber risk, #1 concern in a lot of countries, and was on average the #1 concern through the world. You see where it was first, second, or third. But I also wanted to flag we do a report every year in Latin America as well within our consulting group, and cyber's been rising on there as well. So it's #1 in the world, as you see on the right-hand side in our survey as well, but it's moved up to #3 in this region. Didn't quite make the top 3 in the global risk report this year, but it's moving up. We know that there's a dynamic cyber market that's starting to develop here in Brazil, and I think that it's just a flag on this real-time risk management to put these devices in. You also have to start to be conscious of what's happening, what is that doing to your cyber risk, and monitor that as well. Fortunately, cyber is one of the risks you can monitor real-time as well and get real signals, but it's something that you want to put in place in parallel with some of the developments I described earlier. So looking ahead, I guess my main message to you all today is that change is coming, and I know with this audience, you're probably already embracing the change, but I think as industry participant, I also would say to the rest of the incumbents in the industry, we need to embrace this change, and it's in different forms: data science, the technological advances, new policies, new types of insurance, new forms of capital, and there's going to be new risks that emerge from these technologies that we're going to have to work through. And just as one example, when you think about autonomous vehicles, of course, reduce risk on the one hand, in that if estimates would say accident rate will go down very substantially with autonomous insurance. But on the other hand, now let's say you're the car manufacturer, you now have a new product liability risk, because while people and their personal auto insurance policies used to be responsible for accidents in the past, now if it's autonomously driven, you're going to go after the car manufacturer, the software provider, and there's going to be new liabilities that emerge there. So the risk will shift, and it's again creates new opportunities for the industry in that regard. So my closing thought, just to quote Bill Gates, obviously pioneer in many of the realms of technology, but I thought his quote here from 1996 is very apropos of the insurance industry today, which is to say, we always overestimate the change that will occur in 2 years and underestimate the change that will occur in the next 10. I think that's pretty much exactly how I see insurance today, that you can dismiss everything I said and say, well, this new data, this IoTs, it's sort of not really happening, the industry isn't really changing. That may well be true for the next year or two. You can probably be, but I think if we're here in 10 years looking back, we're going to see very profound change in the industry, and those who embrace it early are going to be the ones who are going to be the winners at that point. So the final comment from Gates there, don't let yourself be lulled into inaction, I think is a stimulus for us in the industry. I think there's going to be change. I think all of you here today showing the interest in innovation. Insurtech is great, because I think it's that there is a lot of opportunity. So on that note, let me close it off and thank you for the opportunity to present today.